Okay, so now we have a question on capital budgeting that you may see on your final exam, project, or assessment in a undergrad commerce class or course, or even maybe a graduate like MBA type of class, or probably not a CFA level one. But the idea here is that you're going to deal with a comprehensive question. It's going to touch on three chapters. One will be on capital budgeting, then CAPM, and our classic time value of money. So this is probably something that you will see on your final exam, and you want to be able to kind of mix all these topics together and get to the solution. So what we're going to do first is we're just going to jump in and read the question, get a sense of what the heck is going on, and then just walk through the steps one by one, and now you'll know how to solve this effectively and quickly. So let's go ahead and start. So if we read this question here, we have Orange Stream, which is Netflix greatest competitor in North Africa. And this company, Orange Stream, has two separate divisions. Okay, so it has two separate divisions, which is one of them will be our online streaming division, and the second one will be the rental services division. Okay, the firm is considering the following independent projects. Now, as you can see, right below that, we have four columns. One displays project, so the name of the project. The second one displays the division, online streaming or rental services. The third one displays the initial investment required. And the fourth one displays perpetual cash flows. How much money will this project be making on a year-to-year basis? In this case, it's perpetual, so it will last forever. So as you can see, once again, within the first category here, we have four different projects: the American licensing deal, the expansion into Spain, renovation of stores, sort of retail stores, and the Japanese licensing deal. We're going to go ahead and we're going to write A, B, C, and D, just such that when we talk through the question, you'll understand that we have four different projects, but I'm not going to say American licensing deal every single time. So I'll say project A, project B, and so on. Within the divisions, I want to make it clear. You can notice that two of these projects are related to the online streaming division, right? So Japanese and American licensing deal. And then two of these projects are related to the rental services division. So maybe if you see this on an exam, this should maybe like ring a bell real quick and say, okay, well, perhaps I'm going to have to use different set of tools for one sort of division and the other sort of division. There's a reason why they're giving you all this information. You know, we didn't finish the question, but already some perspective should be coming along. Okay. Then you see initial investments. Of course, all of these different projects, A to D, will have different initial investments. And the reason why that matters is that, well, initial investments in tandem with your perpetual cash flows, well, if you see this, especially, you know, on a final exam, this should really make you think about NPV, right? The net present value of this project, in which you look at the initial investment alongside the present value of cash flows expected on the project. So already there, you know, once again, bells should be ringing because you understand that, well, it's not a game of just how much total money this project will make or how much total money it costs us at the onset. It's really about figuring out, well, hey, what the heck is the NPV? So already there, I guess I could write here, NPV, right? That should be something that's coming into your mind already there, okay? Let's continue reading. So below these four little buckets, we know that they're letting you know, it's funny, but they're telling you the firm's beta is equal to 1.58. So maybe that could be relevant. Okay, so the firm's beta is equal to 1.58, while the beta of its online streaming and rental services, that's interesting, is equal to 1.97 and 1.58. So notice how they gave you two distinct betas for these two distinct divisions alongside the beta of the entire firm. Now, once again, the bells should be ringing, you know, because we're talking about betas. When do we talk? Sorry, oh my God, my bad. But when do we talk about betas, right? We talk about betas under the capital asset pricing model chapter, under CAPM, under the SML formula. So now, once again, you should be, this is interesting, okay? So we could go ahead on an exam, you would kind of be proactive and you would write a few things as you go through it. So this would be beta of, call it beta F, so beta for the firm. Then you would have the beta of, call it streaming. And you would have the beta of, call it rental services. So you already have a few things that maybe should ring a few bells. Now they're also letting you know, well, listen, the risk-free rate it's 2.8. Okay, so we could go ahead and write that down as well. So RF is equal to 2.8. Now, at this point, it should be extremely clear that we're dealing with some CAPM stuff and that we need to maybe plug this in within a formula later on. Okay, and they're also letting you know that the market portfolio, well, the return on the market portfolio, it's equal to 10.8. So that's awesome news. Okay, so ERM. Of course, different schools, different programs may look at this with a different like label, but what we want to know here is that under the CAPM formula, we're going to write for the market return 10.8%. Now, within all of this information, I'm going to highlight this in red because this will be our mission. So given the above information, which of the above projects, okay, should Orange Stream select? So which project should the firm select? Now, let's take a step back because we've identified a bunch of different information. And with all of this information, once again, a few bells should be ringing, okay? So for sure, because we're deciding on which project to take, we are looking at the capital budgeting chapter. And of course, they're not talking about internal rate of returns, payback periods, or for example, profitability indices. They're just saying which project should you choose, and they gave you the initial investment alongside the perpetual cash flows. So already there, if we go at the top of the page, so I'll zoom in a little bit, all right, and I'm going to write the first set of formulas we want to use, is that we're probably looking at the NPV. Once again, the NPV, really what it looks like, it really compares your initial investment to the present value of future cash flows. And in this case, they gave you the initial investment and they gave you the present value of future cash flows. But they did that for 4 different projects. So in your mind, you should know that you should probably do that little formula for those 4 different projects, right? Because it would make sense. This would allow you to effectively or efficiently, adequately compare those projects. So let's go ahead and write that at the top of our little paper. On an exam, you always want to have your formula sheet with you, because once you're able to identify the formulas you need to use, it becomes a game of just finding the missing piece of the puzzle, because they need to give you some information to plug in. So the NPV of, call it project I, so of a given project, will be equal to the present value of the cash flows less the initial investment, okay? Less the initial investment. Now, I'm sorry if I'm writing slowly. In an ideal world, these videos, they have timestamps. So you're able to kind of just through the video real quick. So just to give you an example of, once again, what the heck the present value of cash flows would stand for and what the heck the initial investment would stand for. So if we were to look quickly at, call it project A, well, the initial investment would be $3.5 million, right? So here we would plug in, 3.5 million. And then the PV of cash flows, well, it would be the present value of these perpetual cash flows. Now, because we're dealing with perpetual cash flows, and remember under the chapter of time value of money, we know that if something, right, is a indefinite set of cash flows that are occurring at a constant dollar figure, we know that we're going to use a normal I can't speak. I'm so sorry, but a normal perpetuity formula. So the classic payment over K formula, okay? Sorry that I'm butchering my words. I guess I'm losing my speech. But the idea here is that in this case, for us to find the present value of our cash flows, we're going to need to use a perpetuity formula. So if we want to like double down, you would go right here and you could say, well, okay, we need to use the payment over K formula to find the present value 0 of every single one of these projects one by one. So that should be something that's sticking in your mind. So that's important. Now, I'll write up the second formula here, which obviously is to find the present value of our cash flows. We're going to need to use, okay, we're going to need to use the perpetuity formula. And I'm having a real problem with saying this word for some reason, but we're going to rock with it, okay? So we could go ahead. I'm going to try to make it cute. So we can go ahead and like write that formula right here. Okay, so at the top, you always want to kind of have a structure in mind. The reason why we're going to write this formula here, so the present value, okay, of cash flows, call it I, will be equal to payment for a given project divided by K. because this is a perpetuity formula. I don't know why I'm struggling with the word, but we're going to have to do that for every single one of the projects, right? One by one, because we know that every single one of these projects, they have a different cash flow. For example, project A has a cash flow of $1.15 million forever, whereas project D has a cash flow of $0.95 million per year, okay? So that's super important. And now the last bucket that's really relevant here, and I guess we'll highlight it in a different color, highlight it in blue, is, well, this question gave us a bunch of information. They gave us the beta, they gave us the risk-free rate, they gave us the ERM, and essentially they gave us all the cash flows and the initial investments. But typically, these questions on NPV, they give you an opportunity cost. They give you a discount rate or an interest rate, or however you want to call it. But this question did not give it to us. Now that's strange, right? They didn't give it to us. So maybe, just maybe, we're going to need to solve for it. And what's amazing is that if you remember from your chapter 8 or chapter 9, if you're taking Comp 308, so Intro to Finance at Concordia, you would know that we could find K by using the capital asset pricing model, right? We could find the expected return or the required rate of return on an asset or on a division or on something. So that's exactly what we're going to do here. The third formula that we're going to need to use, or we're going to need to run through, will be the CAPM formula. Okay, so let's go ahead and once again, I'm sorry that I got to zoom in and write the formulas. And if this is too easy, you could skip ahead. Don't you worry. We're going to go ahead and write down the formula for CAPM. Okay, because that's going to be the last set of tools that we need here. So K is going to be equal to the risk-free rate plus beta times the market risk premium minus RF. Okay, so that's as easy as it is. So as you can see, we have three different formulas that we need to run through to be able to solve for the NPV of a given project, right? If we want to find the NPV of project A, which is under the online streaming division, well, we need to find the present value of cash flows. Present value of cash flows, we're going to use a perpetuity formula in which we're going to do $1.15 million divided by K. Problem is, we don't have K yet. So we need to use the CAPM formula to find K. All right, so that's kind of the setup that we need to go through. Now, quick little side note, in this question, they gave you three different betas. They gave you the beta of the firm, they gave you the beta of the online streaming and rental service division. Which one should you use? Okay, well, let's look at this. There's probably a reason why, if I highlight this here, that they highlighted all these divisions. You know, they took the time to give you a bunch of information on all these divisions. So if you're on an exam, you want to kind of work smart. In this case, if they're giving you specific divisions that perhaps have different, financial characteristics, different exposures to risk, as you can see, well, maybe it would make sense to use beta for those divisions, right? So beta of 1.97 for the online streaming division and beta of 1.58 for the rental service division, and kind of find the K, the required rate of return for both those divisions. And then we're going to essentially give that K, we're going to plug that K in our perpetuity formula for those projects within those given divisions. I don't know if that made sense. Maybe I butchered the way I would maybe I didn't express it the right way, but within the steps that we're going to take right now to solve for these, it'll make sense. So the idea is that we're going to find the betas of both divisions, the online streaming division alongside the rental services division, and then we're going to essentially plug in that K for the present value of cash flows of the projects within those divisions. So therefore, to make it really, really clear, for the American licensing deal and the Japanese licensing deal project, we're going to be using the beta, right, of the online streaming division. So the K of the online streaming division. And for the other projects, we're going to use, of course, another one. All right. So it's really as easy as that. Okay, so let's jump into it. Let's go for it. And we're going to do step one, right? Because we're working, as we would say in French, à l'envers. So we're going to solve for K's at first. Okay, so step one, I'm going to zoom in a little bit just because I want to actually, have the ability to write properly. And for me to do so, I gotta, because I'm using this ghetto pen and this Wacom tablet, I need to kind of, I can't write from afar. Anyways, that's just me trying to make this a little bit more human for myself because I'm staring at a webcam for a few hours, cranking these videos out for y'all. So, hopefully this helps. Anywho, sorry for talking too much. Let's go with step one. So step one in this case is solve for K's. All right, so solve for K's. Now, I'm assuming that you already have this information alongside you, or that you already started to work through the problem, so it shouldn't be too difficult. So we're going to start with finding the beta, I mean, not the beta, but the K for the online streaming division. So I want to call it KO. No pun intended, that's hilarious. So we know that KO will be RF plus the beta of online streaming times ERM minus RF. So in this case, KO will be equal to 2.8% plus 1.97 times 10.8 minus 2.8%, of course. All right, so this is my first time doing the question. I'm not gonna lie, like I've of course already done questions like these, but the numbers I plugged in are unique. So I'm gonna go ahead and plug it in within Symbolab online to see what the answer is, so we can solve it together. And then I'm gonna do a quick sense check to make sure that I don't, put the wrong stuff in and then I bring you in the wrong position. So in this case, we have RF, which is 2.8%, that is correct, plus 1.97, which is the beta of online streaming, times the market risk premium, which will be 10.8 minus 2.8. So I'm gonna do another sense check, and this looks correct. Once you plug everything in here, you're gonna get, wow, pretty big amount for your KO, 18.56%. You're gonna get 18.56%. So that's going to be your KO. So that's going to be the required rate of return, essentially the K that you're going to plug in for all the projects within the online streaming division. Now we could go ahead and do the same thing for our rental services. So I'm going to just move this a little bit. I don't know why I'm having such difficulties using a pen, but it happens to the best of us. So I'll move this all the way here. And I'm going to use a different color a little bit, just such that it looks a little bit cuter. So for our rental services, we're going to have KR. And in this case, it's really the same thing, right? We're going to have 2.8% plus, now our beta, if I'm not mistaken, should be 1.58. We're going to have 10.8% here as per usual, minus 2.8%, such that KR, in this case, I'm going to plug it in once again within our formula, assuming all is well, will be equal to 15.44%, okay? So this is awesome news, because now we're able to really plug everything in within our different perpetuity formulas. So this is awesome stuff. Now, if we zoom out, we'll zoom out once more, just to really give you a view, you can notice, I'm sorry that you're hearing stuff outside there, but we're going to put this as beta 0. Okay, so what's awesome now is that for online streaming, you know exactly which K to use. You know that you're going to use KO, here KO, and here we're going to have KR, and here we're going to have KR. Once again, the reason why this isn't relevant is because we need to plug in all of these Ks within our perpetuity formulas to find the NPV of every single one of these projects. So what I'll do now, I think we're going to find, just because we don't have so much space, I'm sorry about that, but we're going to find the present value of all the cash flows one by one. All right, and I'm going to write them next to our little column here. It'll be easier in terms of spacing. That's such that when we do our NPVs, we could write them nicely and have a lot of space. That's just some logistics nonsense on my part. So this is super easy now. All that we got to do is solve for the present value of our projects. So in this case, what we're going to do is we're going to go through these one by one. So in this case, we have 1.15, right? And because we know we're using the perpetuity formula, it's literally payment over K. But you got to remember, once again, that we're going to use KO for every single one of these projects. Not for every single one of these projects, but for the ones that are, within the online streaming division. So KO, we're going to have 18.56. So you're going to do 1.15 over 0.1856. All right. And that's going to give you a pretty large amount. So for our project A, we're going to have a present value for our cash flows. That's going to be equal to 6.19612. And then for our, I guess I'll go and finish online streaming first, just like that, because I won't have to make so many changes to my formula. So in this case, we're going to have for project D, 0.95 divided by 0.1856. Now, please let me know if I make a mistake in the comments. I'm totally fine with making, an amendment, because it's very possible, right? I'm human as well, so it's not a problem. So for the present value of the future cash flows of the Japanese licensing deal using KO, we're going to have a present value of $5.11853 million, of course. And now we could go ahead and find a present value for project B and C. So for project B, we have 0.85 million divided by 0.1544, because we have 15.44%. That's going to give us 5.50518. 5.50518. And then for the other project, for project C, we're going to have 0.625 million. And here I'll put a million as well. Over 0.1544. Now I know this is the tedious part, it's not the cute part, but you want to be able to get through them, because on the exam you may face questions that are just not cute at all. So we're going to have 4.04792. Okay, so what we did here is we found the present value of the perpetuities for project A, project B, project C, project D. This is awesome news, because now we're able to plug these in within our NPV formulas, and we can solve for the NPV of project A, project B, project C, and project D. It's amazing stuff. So we're going to get to technically step 3. Okay, so I guess I'll write here, I don't know, call it step 2. Okay, and then we're going to write up step 3, which is going to be find the NPV of every single one of these projects. So I believe step 3 is going to be like this. We'll go with green. Why not? It's a nice color. So let's go ahead and make an arrow, perhaps. We'll go here. And let's go with step 3. Solve for NPVs. Now these projects, once again, I mean, these types of problems are not the cutest ones, because they just require a lot of, inputs, they require time, they require for you to be actually diligent, but it's not too bad. So we're going to go ahead and we're going to solve for NPV of project A. So I'm going to coin this as being NPV A. This is super simple, because all that you got to do is you're going to do, once again, don't forget, right? Present value of future cash flows minus the initial investment. So in this case, we're going to have $6.19612 million minus $3.5 million. That's going to give us an NPVA. Now, I'm not even going to try to do this in my head. I'm going to be real with y'all. So I'm just going to go on Symbol Lab and do the math myself. If you're Houdini with it, you already have the answer in your mind, but I'm not going to do that today. 2.6. Okay, cool. So here we're going to have 2.69612 $2.69612 million. That's going to be the NPV of project A. That's awesome news. That's an accept decision, by the way. Let's look at NPV for project B. The NPV of project B is going to be equal to $5.50518 million minus $2.35 million. And this is going to give you an NPV for project B. I'll compute in just a second. So we're going to have 5.50. Once again, if I make a mistake, let me know. Let me know. I always review them afterwards, but still. So here our NPV will be equal to $3.15518 million. Already there. That seems to be bigger than the NPV of project B. I'm gonna go here and I'm gonna write NPV for project C. So that's going to be equal to $4.04792 million minus $1.45 million. That's going to give us a figure that I'll get in just a second. $4.04792. Make sure I'm okay. I can't count. I can't do basic math. That's what I'm showcasing right now. We're gonna get 2.59792 million. $2.59792 million already there. We know that that's bigger than NPV A, but it's not bigger than NPV B. So NPV B seems like it's a pretty darn good deal so far. Here we're going to have 5.11853 million less 2.64 million. So it seems obvious that our answer will be B, but still on an exam, depending on what type of school you're at, depending on what's the requirement, they may want you to actually show your work. So you can't just go ahead and assume that, one answer is greater than the other. So here we're going to have 2.47853. Awesome. Okay. So now you have all of your NPVs, right? You have NPV A, you have NPV B, NPV C, and NPV D. In this case, they want to know, well, hey, what is the best project to choose here? Well, you're going to choose a project that yields the highest NPV. In this case, it's obvious. The project that yields the highest NPV is project B. And the project that yields the lowest NPV is project D. So in this case, our answer will definitely be project B. Okay, so we could go ahead and say greater. So choose B. All right, so just like that, you got your answer. Now, this is an example of a tedious NPV type of question in which you got to select the best project, assuming that they have the same lifetime. And in this question, we had to go through 3 sets of formulas, right? We had to go through the NPV formula, but that wasn't enough. We had to find the present value. And in order to do so, we had to use a perpetuity formula, but we didn't have our K. So we had to use CAPM to find the required rate of return for both divisions. Now, once again, what's awesome here is that we really had to think about it and plug the right K in the right project. And with that, we were able to find a bunch of different NPVs. Then it becomes easy. You just choose the one with the highest NPV. I hope this question gave you a view of what you could potentially see on an exam, project, or assessment. And then I empowered you with the tools to kind of, do this effectively and how to break down a question, how to identify key variables, and how to walk through them step by step. For sure, this wasn't the cutest version of an NPV question, but that's often the case when you have an exam. So hopefully this helped. And before you go, or if you're still here, you can definitely find more tools on eastmanhelps.com, like hundreds of questions on Intro to Finance per topic that are categorized for you. Or you could go on my YouTube channel, if that's where you are right now, and you could find a bunch of videos that go through those questions step by step, just like we did here, and kind of just choose what works for you. and take a step back, look at it on demand alongside the previous crash courses that I posted back in the days. So all of that is tools that hopefully make this learning process easier and a little bit more human for you. So yeah, that's the end of my spiel. I'll see you around. And yeah, hopefully this helps. Bye-bye.